Oil near triple digits, bond yields grinding higher, and AI stocks still powering index highs. That collision between energy shock risk and a narrow tech melt-up is defining today's equity backdrop. Welcome to vTalkInsight, Equity Pulse Daily for May 12, 2026. Let's unpack how geopolitics, inflation, and AI earnings are pulling markets in opposite directions. The macro story starts in the Gulf, where US and Iran talks have broken down again, and energy markets are reacting fast. President Trump's rejection of Iran's latest offer has pushed Brent crude above $104 and West Texas crude close to $98, with prices jumping around 3 to 4%. That move is not just about headlines. Iran is signaling it can disrupt the Strait of Hormuz and still has a large share of its ballistic missile arsenal, so markets are building in a higher risk premium for both oil and global bond yields. The deeper concern is duration. Saudi Aramco's leadership is warning that a prolonged closure of the strait could keep oil markets dislocated well into 2027. Inventories are already being drawn down, diesel crack spreads are back near conflict-era highs, and the United States is tightening sanctions on Iranian crude and shipping, all of which point to tighter sour crude supply ahead. That combination points toward a classic stagflation risk, especially for Europe, where an energy shock on top of already fragile growth could push inflation back up while output stalls. Policymakers are watching this closely because the inflation picture was already complicated before the latest oil spike. U.S. diesel prices have surged, a pattern that historically feeds into consumer price inflation, and supply disruptions in products like helium and naphtha are expected to bleed into core goods later this year. At the same time, service sector inflation remains firm. Long-term expectations have drifted modestly above pre-pandemic norms, and the Federal Reserve is losing room to maneuver as Jay Powell's term ends and expectations for rate cuts slide out toward 2027, with some even discussing the risk of another hike. In Europe and the UK, bond yields are already moving higher on oil-driven inflation worries and rising political risk, and there is talk of so-called insurance hikes if energy flows do not normalize. Yet, despite all of this, the main U.S. equity benchmark is still close to its highs and volatility indices are only in the high teens, suggesting equity markets have not fully priced an adverse Gulf scenario. Against that macro tension, the earnings picture still looks remarkably strong, and that is what keeps equities resilient. Analyst estimates for the S&P 500 have been revised steadily higher, with forecasts now pointing to roughly 23% year-over-year earnings growth, an unusually robust number outside a classic post-recession bounce. Corporate cash flows are at record levels, helped by solid consumer spending and a still firm labor market, and the median large-cap company is growing earnings in the mid-teens, while headline technology and hyperscaler profits are rising by more than 20%. The real outlier is anything linked to artificial intelligence infrastructure. Semiconductor indices are up on the order of 60+% this year, with 7 chip-focused names accounting for a dominant share of S&P 500 returns and a large slice of emerging market performance. Hyperscalers are on track to spend more than $800 billion on data centers and AI chips, a figure that rivals major sovereign budgets, and AI compute demand has shifted from steady growth to triple-digit expansion. Companies like Cerebras are seeing their initial public offerings oversubscribed many times over, while model builders such as Anthropic report revenue ramps from single-digit billions to tens of billions annualized in just months. One nuance is that many chip makers book AI server revenue upfront while amortizing related costs over years, which flatters near-term margins even as the sector still trades at relatively modest multiples due to long-standing fears about eventual cyclicality. That strength comes with concentration risk. Even as the main U.S. index makes new highs, only about half of its members sit above their 50-day moving averages, the weakest breadth seen for a fresh high in decades. Momentum factors are surging. The semiconductor ETF complex is up sharply this quarter, and options flow shows heavy retail demand for NVIDIA calls being met by institutional call selling, while names such as Intel, Micron, and Qualcomm exhibit more one-sided speculative activity. Globally, Asia is deeply plugged into the same AI cycle. The Kospi in Korea has more than tripled from last spring, yet is still described as inexpensive on forward earnings because profits have risen even faster, and strategists continue to highlight South Korea and Taiwan as high beta ways into AI hardware and materials. At the same time, China is exporting reflation through higher producer prices, driven by energy costs and AI-related materials demand, and Asia-Pacific indices are reporting earnings growth north of 30% this quarter, with technology earnings up well over 100%. Beneath the index level, sector rotation is telling its own story. Energy and technology are leading gains in Europe and globally, with energy sectors recently up more than 2% in a single session as higher crude prices and geopolitical uncertainty lift cash flow expectations for integrated majors. Names like BP have benefited from analyst upgrades tied to deleveraging potential in the current commodity environment, while Saudi Aramco just reported a 26% rise in adjusted net income, showing how higher prices can offset lower export volumes when pipelines and logistics cooperate. By contrast, more rate-sensitive and defensive groups such as insurance, autos, communication services, and consumer staples have lagged, even as parts of healthcare that provide essential products like catheters and syringes are seen as undervalued despite steady demand and ongoing buybacks. Cyclicals are also giving mixed signals. Small caps, as tracked by the S&P 600, have actually outperformed large caps year to date, helped by expectations of faster earnings growth and leverage to the manufacturing upturn, even though the headline narrative is still dominated by mega-cap AI winners. In Europe, higher jet fuel costs are pressuring the outlook for civil engine makers like MTU Aero, while peers such as Safran are viewed as more resilient, illustrating how the same energy shock can create winners and losers within a niche. Financials are another worry spot. Bank stocks, which had been part of the bullish case, are softening as two-year yields rise and the curve flattens again, and technical indicators suggest the recent equity melt-up could be tiring, with high dispersion creating more room for long-short and market-neutral strategies to exploit mispricings. Company-level news around AI and digital infrastructure continues to shape leadership and sentiment. Alphabet has just delivered its best monthly performance in years and is closing in on Nvidia in market capitalization, underscoring how investors are reassessing which platform owns the next phase of AI. Microsoft's roughly 27% stake in OpenAI, acquired for around $14 billion and now valued near $200 billion, highlights the scale of value being assigned to foundational models, while OpenAI itself is raising more than $1 billion to fund global deployment and acquisitions. On the hardware and infrastructure side, Intel has reportedly struck a preliminary manufacturing deal with Apple that lifted sentiment around its foundry ambitions. Flex is spinning out its AI-focused cloud and power business, with projected revenue growth of more than 60% this year and even faster next year. And a broader build-out of solid-state and grid infrastructure is expected as power density needs climb. Outside core tech, several names are flagging how capital is being reallocated and where stresses are emerging. Barrick has beaten earnings expectations and announced a $3 billion buyback, reinforcing management confidence in long-term gold demand, even as recent gold price weakness is linked more to forced liquidations and margin calls than to a loss of safe haven status. In healthcare, Moderna has rallied on early-stage work on a hantavirus vaccine, and other developers of rapid response infectious disease treatments are also gaining, while HIMS faces a very different dynamic as its switch from compounded GLP-1 drugs to branded products from Novo Nordisk is expected to compress margins from over 60% to low double digits, a shift not yet fully reflected in consensus estimates. In credit, a cluster of business development companies is showing strain. Defaults in Apollo's mid-cap financial vehicle have risen from roughly 4% to just over 5% in a quarter. KKR is injecting capital, waiving fees and buying back shares in its own BDC to stabilize it, and Apollo is exploring a sale of an underperforming listed credit fund at a discount to net asset value. These issues look more tied to aggressive underwriting in areas like consumer healthcare than to AI disruption, but they sit uncomfortably alongside high-yield spreads that are as tight as they were in 2007 and elevated cash allocations in portfolios, pointing to hidden leverage and the potential for sharper repricing if macro or earnings conditions deteriorate. Pulling this together, equities are still being held up by a powerful earnings cycle and a historic AI investment boom, even as the macro backdrop deteriorates around the edges. Oil prices and diesel spreads are flashing clear energy shock and stagflation risk. Central banks are being pushed toward higher for longer policy stances, and consumer sentiment remains fragile despite solid labor data. At the same time, index gains are heavily concentrated in AI and semiconductor names, breadth is thin, and early stress is emerging in banks and private credit, while sector rotation lifts energy, selected defensives, and parts of healthcare. From here, the key watch points are the trajectory of the Gulf conflict and oil flows, upcoming U.S. inflation and activity data, any shift in central bank rhetoric, the sustainability of AI-driven earnings and capital spending, and whether market leadership broadens beyond a handful of tech and chip names. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.